Hello friends, welcome to 5paisa School. I'm Indu Chaudhary. Before we start our first masterclass, I would like to tell you why we have taken this initiative. Actually, we have seen a lot of apps and websites providing news and updates on stock market on daily basis. But one key factor is missing everywhere, and that is stock market education. 5paisa has identified this missing part and created this unique platform to educate people. In 5paisa School, we will provide in-depth knowledge of market, investment, trading, and will break every topic in a simplest way. Today, we will explain about technical analysis part 1. And to make you understand this concept, I want to introduce our special guest, Dr. Sangeet Wats. She is an associate professor in the area of finance and accounting in NMIMS Mumbai. She has done her M.Pharm, MFC, and PhD from Banaras Hindu University. Dr. Watts has been into industry for over 17 years. Her area of interest in teaching includes risk management and derivatives, portfolio management, fundamental and technical analysis, and many more things. So, Sangeeta, we are very excited to have you in 5paisa School. Now, I would request you to take this discussion forward.
Thank you, Indu, and it's been a pleasure to be associated with 5paisa.com. So let's start the journey. Uh, a very warm welcome to the technical analysis sessions. And this happens to be the very first session on technical analysis. Right? So I'll be touching upon the very basics. And with the subsequent sessions, I'll be going into more depth. Okay. So today happens to be the very fundamental session on technical analysis. Uh, Fine. So I hope that all of you must be associated with the stock market in some way or the other. And you must have heard about this term, technical analysis. So essentially, what is technical analysis? Indu, can we have the slides? Yeah. So, coming to this. So what is technical analysis? Now, let me just give a word of caution over here that, don't be too much overwhelmed to trade in stocks or any other asset class till you know the nuances of technical analysis in detail. Okay, so I would say that this particular notation actually sets the tone of the importance of technical analysis, right? So let me just take you through the very first one. I'm on the first slide. Okay. So what is technical analysis primarily? Technical analysis is the study of charts, and we try to get inputs from the chart for our decision making with respect to whether to buy or whether to sell. And all this is primarily dependent upon the kind of price movements and also the way the volumes are changing. The way the volumes are changing. Now, what are volumes essentially? Right? So you should know the very basic terminologies. Uh, Volumes is the number of shares of a security traded between its daily open and close. And if you see, not only the price, because the price actually says which direction the market is moving, it's moving up or it is going down or it is static for the time being. But volume also plays a very important, a very significant role in technical analysis because it is used to measure the relative significance of a market movement. So the higher the volume during a price move, the more significant the move, and the lower the volume during a price move, okay, the less significant. So that is the very importance of the volume while we go on with the journey of technical analysis. So essentially, we have to see the price movement and the way the volumes are changing. Uh, so technical analysis. Into the third one, fourth, the next slide. Yes, thank you. To the fourth slide. Okay, so technical analysis, if you see, it is the study of forecasting future, okay, future price based on an examination of the past price movement. So essentially, we are dependent upon the historical data, and based on the historical data, we then try to sort of forecast what is going to be the market movement going ahead. And so essentially, what we do is first we do the forecasting, excuse me, followed by trading, whether it is buy or whether it is sell. So which is based on the signals which we get after analyzing the chart pattern. Now, when we refer to technical analysis, okay, we have to concentrate primarily on three things. So as you can see on your screen, we try to figure out or we try to study the price chart, okay, which direction it is moving and all of that. Next is we then try to understand or assimilate the information related to demand and supply. So the forces of demand and supply are very much predominant in the understanding of technical analysis, and we'll see how it works. Third is it depicts what the masses think. So all these charts essentially they try to understand what are the mass thinking, what is the herd behavior at that point in time. So technical analysis, if you see, it works best in case of stocks which are having high liquidity. Okay, so what do you mean by the term liquidity? I'm just touching upon the very basic things so that it's very clear to you. So a liquid stock is a stock that trades enough of shares for the traders to sell at any point in time, and the difference between the bid price and the ask price happens to be very, very less. Right? So, uh, if the trade volume is very, very high, we understand that the stock is very liquid. Or if the difference between the bid price and the ask price is very less, we then also sort of infer that that particular stock or that particular script happens to be very, very liquid. So you always find a market. So if the seller wants to sell, there are always buyers. If the buyer wants to buy, the sellers are there to sell. So actually, if you see, it enhances more the liquidity, more is the price discovery, and more of it is reflected in the form of the. So all these things go hands in hand. What is bid price? A maximum price which a buyer is ready to pay for a share. And what is the ask price? The ask price is the price a seller is willing to accept for a particular skill. These are some of the very basic things which I thought it's better to sort of discuss with you. Now let's move to the understanding of the very first aspect, which is study of price chart. We now move to the next slide, study of price chart. So as you can see in this particular chart, you see that there is a particular trend which is to be seen from the changes in the prices, from the changes in the prices. And if you see, there are some red bars, there are some green bars, as you can see. So the green one are showing the optimistic trend or the positive trend, and the red ones are showing or are reflecting the negative trends, right? All right, but essentially what you see is that the price are moving in a particular direction with little bit of changes here and there. That all is dependent upon the information which is coming in the market from time to time. So the price might change within fraction of a second. So the market is very low, and all of a sudden there is an information, you know, thereby giving a trigger, and the markets are moving from there on. So essentially, if you see, technical analysis is related to the study of price movements, and you have to be very, very specific. You have to be very, very sure as to what that price is indicating to us. It might indicate that the markets are very volatile, or the market is stagnant, or the market is going up, or the market is going down. All right. Next is, it is based on law of demand and supply. So all these charts, all these price movements, they are essentially based on the law of demand and supply. So it's just like the market forces. So higher the demand, supply being less, prices definitely will shoot up. Okay? Whereas on the contrary, high supply, no demand, the prices are going to come. Okay, so that is what forms the basis of an increase in price or a decline in price. Right? So you have to be very careful as to what is the kind of demand and supply existing in the markets. Demand very high, supply also high, then you will find that there is not much of a movement to be seen. But major movements are actually understood and to be seen once when the demand is very high related to a particular stock or index and the supply is less. Okay, so what happens? The buyer is ready to give a higher price. The buyer quotes a higher price so that he gets to buy his favorite stock, which pulls up the price. Okay, and the trend goes up, right? That is how it works. And if the supply is on the higher side, no takers in the market, no buyers in the market, what happens? Prices, it starts coming down. The next is the market psychology. So all these price charts which we see, okay, the charts essentially, they are a depiction of the mass psychology or the herd behavior. So we understand that we all want to be in a herd, which means what? We want to be there in a group. So if the group thinks that from here on the prices are going to take off, okay, or if it thinks that from here on the prices are going to come down, so all the members, all the individuals within that group will start behaving in the same fashion. Okay, and ultimately that will be reflected in the prices and of course in the volumes. So the charts are an assimilation of all these three components, that is the price movement, the change in the demand and supply, and third is the behavior, the group behavior, or the what the masses think about that particular stock or of that existing time period. So now, if you see the existing time, we are not seeing much of a trigger happen. So we are all waiting for a big boost, okay, or so market is actually not able to comprehend that where exactly it is going to go. So you find that the market right now is somewhat range bound, right? Because off and on we are getting to hear some uh, negative news which is having a dampening impact, and then the very next day we find that some positive trigger and the prices goes up. So essentially, if you see nowadays, if you see for the past, I would say few days, the market is moving sideways. We are not seeing much of a trigger happening. So some, except for a few days, if you see last week there was a huge fall, and again it recovered within 1 or 2 days because of the kind of trigger which is happening. And it is this, this is what you have to sense. And if you are able to sense it by looking at the charts, okay, and there are various types of chart, which is what we are going to discuss going ahead: line chart, bar chart, candlesticks chart, and what all these chart has to explain about the market movements. So if you are able to track this, you will be able to make the most use of the charts, and thereby you will be able to take the positions and thereby gaining from this technical analysis. So as I was saying, we now move to the next one, next slide, and we see, so one very important thing is why technical analysis is required. Already there are other forms of analyzing the stocks or the market, like your fundamental analysis, right? So why do we require technical analysis per se? So the whole idea is technical analysis. The benefit of it essentially is very short-lived. And within that short period of time, you are required to enter the market, whether you want to be whether you want to sell, whether you want to buy. So the market, you have to be very proactive, okay? Because you don't know the very next moment what is going to happen. So you have to actually capture the market sentiments based on the kind of information which is flowing in. Accordingly, you have to act, and only if you act, you know, if you act promptly, it is at that point in time that you will be a real gainer. So you have to actually sense the market. And remember, it doesn't happen in a day. It takes a little bit of time to sort of assimilate all these sort of information, all these things, right? Now, when I say that technical analysis is not for a very long period, okay, it's very short-lived because it is in that very short moment that you have to capture the opportunity. Now you can always question that, madam, how short is short and how big is big? So that is always debatable. And the time frame in which the technical analysis is applied maybe ranging from few seconds or a minute or 5 minutes or maybe 30 minutes or an hour, or maybe the uptrend continues for the entire day. Okay, or it may be on a weekly or a monthly, or maybe it may be for a long period of time, so many years. So that is absolutely possible. Okay, so you have to be very careful as to the kind of time horizon for which you are actually planning to, do the trading based on the technical analysis. Sometimes the market just gives you an opportunity of nanoseconds, and within that you have to act. So it's like just like if you miss that opportunity, it's like missing the bus. So you have to be very, very sort of proactive, right? Now, I was discussing about the types of chart a while ago, and I said that there are various types of chart patterns, like line chart, bar chart, or the candlestick chart. Okay, so all of these charts have to explain something of the or the other, and it is the study of these specific charts which will help you to identify when to enter, when to exit. So it's a whole gamut of study, which is which is there in the form of these charts, and you have to really have to understand each and every nuances, each and every aspect of this chart type to finally gauge as to which direction, what the market is, or what the prices and the volumes are sort of trying to, indicate or trying to tell you, right? So I'll just show you the line chart in the next slide. So this is an example of a line chart. And overall, if you see what is happening in the market, overall the market has gone up. Okay, so if you see right from 1990s to 2010, which is what the chart is showing, the overall trend is that the market has gone up. Okay, so which means it indicates lot of factors existing in the economy, and essentially it says that in the long period of time, the market sentiments has been. Okay, but again here also you see that there are certain declines and again reversal, and so that is also giving you an indication, as to when to sort of exit within that primary trend. Primary trend is a trend which exists for a longer duration. It may be for years. It may be for years. So within that primary trend, which is reflected for a long period of time. So as we are seeing, the chart is from 1990 to 2010. So for all these 20 years, the primary trend is very bullish. So it's going upwards. But within that, you see that there are some drops. Again, it's recovery. So how will you then take your positions in this given situation? So this is what we will try to sort of learn as we go ahead. Next is the candlestick. Next is your bar chart, and you see that within this bar chart also you find that it is falling, it is again going up, again falling, again going up. All right, but overall, if you draw a straight line or a tangent line, you find that from December to 2009 February, the market is actually Okay, and you are seeing some kind of a ticks over here. So what are all these ticks signifying? Okay, you find some ticks on the right side, some ticks on the left side. So what are these indicative of? And this is what we have to learn. Okay, so just to give you a snapshot as to how a bar chart look and what these ticks has to represent, and you also see within this that some uh, bars are very long. The range is on the I mean they are very longish, whereas some are very short. So what all these reflects essentially, and how will you then would want to capture the information which is being reflected all these the bars actually, and of course the ticks which are on the right side and the left side. So we will I'll just explain it to you, the very basics of this bar, and then we will be moving to the candlestick. So if you look at the candlestick chart which comes next on your screen, right? So this is, so just as we are having a line chart and a bar chart, we also have a candlestick chart, and this actually originated from Japan. So this is essentially what the analysts they bank upon because of the immense amount of information which we get to see from this candle chart. And you see again in this case there are some green ones, there are some reds, okay, and in some cases you find that the candle is quite longish. In some cases you find that the candles are very shortish, even though they are green, but they are short, small in size, and you are seeing some red which are big enough and some red which are sort of very small. So what is this indicating? So again, there is a entire analysis which you can do just by looking at the candlestick chart. And each and every candle has to explain something about the market sentiments, about the demand, about the supply, about the kind of information which is getting discounted, which is getting reflected through all these candlestick charts. Okay, so what this essentially means, okay, what does green means, red means is what, and of course the other aspects related to candlestick is what we are going to uh, understand as we go ahead with our subsequent sessions. Let me now take you through the emergence of technical analysis. Right? So if let's we can come to the next slide. So emergence of technical analysis. So it is understood that or that the very basics or the very starting point in technical analysis happened in US, and the initiator of this technical analysis was Charles Dow. Okay, it is on his name that the Dow Jones is named, and he was the first one to start with the Wall Street Journal, famous Wall Street Journal. I hope you are aware of that. It is said that he is the one actually who started off with this entire process of technical analysis, or this entire study of technical analysis. So what he, and you know what, it is still followed even now. It is still applicable in today's context. Okay, but there are a lot of revisions which has taken place. Right? But nonetheless, the very basics remains intact. So there are various revisions, there are various versions, but the overall, if you see, the basics remains intact, right? So this is an example of your Dow theory, and I'll just take you deeper into it, right? So what you see is that January 12th, so the chart essentially depicts the price movement from January 12th to April 14th, a period of almost 2 years, a little bit more than 2 years, 2 years and 1 quarter, you can say, all right, or maybe 13 quarters, right? So you see that somewhere in the month of mid, not mid, I would say, but somewhere in the month of March, okay, we can take March, okay, for the ease of our understanding over here. So somewhere in the month of March, the price had fallen significantly. I'm just explaining what the Dow theory essentially has to convey and how you can use the Dow theory for your decision making. Remember, this is the starting point of your technical analysis. Okay, because we are essentially trying to understand when to enter and when to exit, right? So, if you understand Dow theory, I think you are getting the very basis of technical analysis. Okay, so yes, so you see that somewhere in the month of March, the market had dipped down, and then what happened? The market went up, and then it went somewhere in June 13, it went further up, and somewhere in the month of April 14, it went further up. So if you look at the primary trend, the trend has been, so from that March 12 to let's say April 14, okay, the trend has been bullish. Overall trend has been bullish. But within that, you are seeing that there are some, market has fallen, again it has picked up. Okay, so that kind of a changes do happen. But overall, what is the trend? It's bullish, right? So understand, investors who are, or we say the informed investors or the rational investors, they are the ones who will enter at this point in time. Which stage? You are seeing something written as accumulation phase. So it is at this point in time that they will be entering the market. Now you might always debate, madam, why to enter in a falling market? Because we don't know whether it is going to fall further. Yes, you can always question that. But once when the market has touched, I would say, rock bottom, and you are seeing that okay, there is no further scope of falling, that is the time once when the informed investors or the rational investors they start buying. They start buying, as you can see, at a very low rate. And you may be thinking that is this the right time to buy? We don't know where the market is going to hit from there on. But the informed investors, they know that it has actually touched the rock bottom and it is now going to take up because the economic cannot be going down and down and down forever. Somewhere it has to pick up. So there is always a reversal which is happening. Right? And so if we have referred to the business cycle or the economic cycle, that is how it moves. So not a single stage stays for a long period of time. So once when it has reached rock bottom, for sure there will be some kind of a bailout by the government or the economic activities going to pick up. And from there on, the market is also going to pick up. So it is at that point of accumulation phase which you can see that the market is the informed investors, they will buy as much of stock as possible. Right? Subsequently, what happens? As the market, as the economic activity grows, market also increases. Market is bullish. And it is at this point of a time that there are some more investors who, as a part of that herd behavior, they also start. Okay? And you see that why? Because the quarterly results are positive because the economy has picked up. The quarterly reports of the organizations are positive, which is again reflected in a higher price, right? And the market further picks up from there. So it is at this point of a time, maybe, that people like you and me who are very scared of the falling markets, they get a little bit satisfied. Okay, chalo, now the market is moving, market is going up. So it is the time for me to sort of. So this is what is called as the. So now various people are very happy. They are satisfied. There are a lot of there is a lot of confidence. Okay, because of this uptrend which has been continuously going up for a considerable period of time. Okay, so public participation starts happening, which further pulls up. So demand increases. Understand the demand increases. If the demand increases, price automatically is pulled up. Okay, and as the economy flourishes, there is more demand. Okay, more economic activity taking place. Okay, what happens? The prices further. Of course, there are some kind of troughs which you can see, and again, you find that there is a little bit of reversal which is happening. There are troughs. Okay, but essentially, the market, if you see, is going up. It is at that third stage, okay, wherein you can see it's written in the box distribution phase. So it is at this point in time that all these informed investors, all the rational investors, they would want to make an it. Why? Because they have got a good price for their investments, okay, or for their purchases. And it is at this point of a time, like uh, investors, novice investors, they will say, okay, fine, the market has moved considerably high, and it is now the most appropriate time for me to. So once when the market touches 41,000 or 42,000, okay, there were many investors who were very confident, and now they are gaga about the market, and they say, oh, market is the best place to sort of make money. Okay, but it is at this point, so they enter at a very high rate. So they buy the stock at a very high rate, and it is at this point of a time that this informed investors or the rational investors, they sell out and they move out of it. Please understand, once when the market has hit a peak, okay, or if there is a resistance for a considerable period of time, you can expect for sure market. You can expect a market reversal. It means what? The market might come. So we saw. So this is about Dow theory. And so I hope you have understood sort of the accumulation phase. And if I can just take a minute more to explain the Dow theory and its relevance even now. Its relevance even now. So if you see what happened in the month of March 2020, markets they fell like anything, and we were all scared that we don't know what is going to be the rock bottom. And I guess it touched like what 28,000 if I'm yeah, sellish. I'm seeing something nanosecond will be applicable to intraday traders. Technical analysis is applicable for intraday traders. Essentially, technical analysis, if you see, is for a very short period of time, and that is wherein I was discussing how short is short and how long is long, right? So I had already given my input with reference to that Salish. Yeah. Okay. So yeah. So coming to what happened in March 2020 and applying the Dow theory and just making you understand that it is still relevant even after more than a century. It was propounded by Charles Dow. Even now, it is having its significance, right? So you can say that the history repeats itself. That is what the technical analysis is. Okay, the charts, the price patterns, they sort of repeat, and it is based on that you have to make your sort of forecast as to what is going to happen going ahead. Okay, so yeah, I was talking about what happened in March. So the market fell down heavily, and we were all in a state of panic. We didn't know what is going to happen. Okay, and with those geographical tensions increasing, the trade tensions again increasing, we were all in a state of panic that we didn't know what is going to be the rock bottom. But then what happened? There were certain stocks or the markets in a way. There were some triggers, some positive information, okay, which was discounted in the market, and the market further. So the ones who were witty enough, informed investors, they thought it is an opportune time for them to enter. So had they entered at let's say 28,000, and I think it's 39,000, they would have still made money, even in this so-called sort of recession, because we get to listen so many versions from the economist. Economy is in recession. Everybody says everybody's having their own opinion. You cannot stop anybody from giving their opinion. But understand, those who entered at 28,000, okay, and sort of had exited at 38, they made profit, even in this so-called time of recession, and with so much of uncertainties prevailing in the market, especially with reference to certain stocks. Yeah. So this is what you have to sort of imbibe, that how you will, what is the right time to enter and what is the right time to exit. So Dow theory sort of portrays this thing very, very effectively, right? And it is still very much prevalent. Okay. So primarily, if you see, Dow theory is to determine changes in the primary market. And once the trend is established, it is assumed to exist until a reversal is proved. So let's say the market is going up, up, and up, which means what? It's green signal. But let's say for any particular day or 2 or 3 days, if there are some red signs, which means what? Red is reflecting negative, impact or negative information. So then you have to be, that is a time when you have to be cautious because market has moved up. Because of these red or negative sentiments coming, you then have to be a little bit cautious that which direction the market is now likely. Okay, so you have to, and most likely, if the trend has been bullish for a long period of time, and with these kind of red signals, it's quite likely that a reversal is going to happen. That means the market is now going to move contrarily. Like so, there is going to be a market reversal which is likely to take place. That is what is primarily understood. But then again, you have to understand the market sentiments. So it's not that one thing which goes into. There are so many things which sort of has to be taken into consideration prior to prior to you making your own position, right? And how to capture that is what we are going to learn as we go ahead. Uh, Fine. So essentially, the peaks are signals to sell shares, and the troughs are signals to buy shares. That is what we have sort of understood from our Dow theory. Okay, we can move to the next. Okay, so Dow theory, if you see, it is based on these three primary aspects that price discounts every piece of information, price movements are not totally relevant, and third is investors can identify facts associated with the price. That is what we understood from that discussion about the entering phase and once when the other investors will come in and when the informed investors will exit. So this is what is the very basis of Dow theory. Essentially, in technical analysis, everything is based on the price, and as the prices are going up and down, you also have to see the changes in the volume. In fact, that volume gives you a kind of more confidence as to which direction the market is. If you are a little bit confused, look at the volumes with respect to the prices, okay, and that will give you a lot of inputs as to what the market is actually trying to say you. Okay, we can move to the next one. Yeah. So essentially, I was discussing about the three trends which are witnessed in a market. That is the primary trend, the secondary trend, and the minor trend. Okay. So coming to the next slide. Yeah. We can move. Yeah. So here it is primary trend. What is primary trend? All right. So primary trend can either be bullish or it can be bearish. Either ways, right? And if you see the primary trend, as we have seen in that previous chart of ours, that it can last for more than 1 hour or may even last for several years. So at one point of a time in the Indian market, we were seeing that the market was going up, 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 and up. So the primary trend was bullish, or you can say that the primary trend is bearish. So it can be either ways. Okay, but it exists in the market for a comparatively longer period of time. So if the market is making successive higher highs and higher lows, the primary trend is up. So what is higher high and higher lows is what we are going to understand in a while. And if the market is making successive lower highs and lower lows, the primary trend is going downwards. Okay. Next is the secondary trend. Secondary trend are essentially, as you can see from this particular chart, it's very nicely explained. So the primary trend is depicted by that red arrow, as you can see. And then the secondary trend, which are reflected by those purple arrows. So what are these secondary trends? Are intermediate corrective reactions to the primary trend. So there are the corrective reactions. Maybe you got some information and the market is, the market is very proactive. And so there is a little bit of correction. So if it is going up with this kind of an information setting in, the price might come down. And these reactions typically might last for a month to 3 months, okay, and retrace from 1/3 to 2/3 of the previous secondary trade. So it's very short-lived. It may be for a period of a month or 3 months, okay? And again, depending upon the kind of information which is coming in, again, it is going to have a kind of, a sort of, the market will again move forward in that direction, in that positive direction. I'm seeing a little bit of chats, and yeah, I'll come back. RSI indicator, why doesn't work in case of Airtel? Yeah, so what is RSI indicator? We are going to discuss it subsequently in the, all right? Right, so yeah, so I think Kritik has sort of mentioned. So I'll just come to all of that, RSI. I'll just come to all of that. Just give me a little bit of time, okay? All right, coming to the next one. Not to worry, I'll come to all of that. RSI, Bollinger Bands, oscillator, Fibonacci, William, percentage Williams, and all of that. So it's there in the pipeline. Not to worry, not to worry. All right. Coming to the minor trends are very short-lived. So if the company has declared a very high dividend, obviously you will find a spike in that particular stock. But remember, this is only short-lived. And also understand that you don't make your decisions based on the minor trends, because minor trends might last for max to max maybe 1 week to 3 weeks and not beyond that, because ultimately they are very short-lived and they are just based on a specific piece of information, and that specific information will only last for a very small period of time and not for a very long period. So let's say if one company decides to acquire another company, there will be a quick trigger which will be seen in the market. So unless and until it's very promising kind of a corporate restructuring, you would not want to sort of have your position with respect to that piece of information. So the crux is that should not enter the market during all these triggers, the triggers which are going to last only for maybe a day or maybe a week. Okay, we are good to move. Yes. Yeah. So I think I've essentially explained everything with respect to Dow theory. And as I said, that if there is any uncertainty, always look at the volumes, because it says it reflects the market sentiments essentially. All right, we can move to the next. So yeah, we have discussed all of this. Yes, we can move to the next. Yeah. All right, so here I would like to give 30 seconds or so. So when the Sensex signals a reversal in the primary market, okay, the Dow theory expects a new trend formation immediately. So understand, however, the longer a trend continues, the odds of remaining intact, okay, become progressively smaller. So if you are seeing a bullish trend or a bearish trend for a very long period of time, it's quite possible, or it's very much, or there is a very high probability that the market might show a reversal trend. And that is what has been witnessed, right? Okay, that is what we try to find out from the historical charts for our forecasting. And that is what technical analysis is all about. All right, we move to the next, and slowly and steadily we are moving to the next part of it. What is a trend? Trend essentially tells about the direction as to which way the market is sort of moving. Okay, coming to this, yes, I'm not seeing the chart. I think there is something which is missing. Yes, 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 yes. Yeah. So, trend in terms of direction. What do you see? I was just a while ago, I was speaking about higher highs and higher lows. Okay. So, higher high, as you can see, H1 reflects what? H2, H3, H4. So, with every consecutive day, you find that the market is continuously touching or reaching to higher highs, and the lows are also they are also on the higher side. So we are also witnessing higher tops, and we are also witnessing higher lows. So this kind of a trend indicates a bullish sentiment, and this kind of a triggers actually say This is the best time to sort of buy. Okay, this is the best time to buy. But remember, you have to understand what is that level at which you are entering. What is that level at which you are entering? Usually, what happens is that some of the informed traders might make the most of this and might want to come back. I mean, want to sort of exit from the market. That can also be a strategy. So maybe I think that it's a good time for me to sell. You might as well think it's a good time to buy just by looking at the chart and the kind of positions which we have held in the. So there are certain kind of, so it's essentially how you infer all of this. Okay. Okay, we can move to the next. So this is higher highs and higher lows, which essentially indicates the market going upwards. Another thing which is very common is once when we witness a lower trend. So lower trend is essentially once when the market is moving down and we see that with every subsequent trade or every subsequent day, there is a lower high, which means there is a lower top and there is a lower low. And if this kind of a trend is witnessed day after day, okay, then it reflects a down trend or a bearish trend. And this was essentially what was happening somewhere in the month of March. Another trend which you should also sort of understand is the the sideways move. What is sideways movement? So market is trading within a range. You don't see much of a movement neither on the upside or much of a movement on the downside. So market in a way, if you see, it's range bound. And the investors are, they don't know actually which direction the market is going to go. Is it going to go up or is it going to go down? So they're all confused essentially, or they are just waiting for a trigger to come so as to sort of understand what positions are they going to take in the market. So this is what is referred to as market moving sideways or market is range bound. So as a technical analyst, you would actually you will be waiting for that trigger to actually come in the market. So whichever direction that trigger is towards, upwards or downwards, accordingly you will be taking your respective positions. You can come to the next. Okay. So this is about our higher highs and higher lows. So this is how essentially the market is constantly falling. Some trigger comes, market goes up, so there is a higher high, and then there is a sort of correction which also happens. So you can see the corrections happening somewhere in that C1, C2, C3. Those are the corrections, and the I1, I2s, I3s, I4s, they are the impulses. Some positive trigger happening and the market goes up. So this is how a market moves. Okay? 20 years down the line also you will see this kind of a pattern. And this is what, and it is based on this that you have to then sort of strategize. Right? Yes. We can move to the next one. Yeah, I think I've covered all of these that in our Dow theory, market discounts everything. So I've touched upon that. We can move to the next. And price moves in trend. We have discussed this. And also I've discussed history repeats. It's approaches to technical analysis, essentially prices, volume, open interest. Okay, so you have to see the open interest, but this open interest is applicable only if you are going for the derivatives trade. Okay, and what is open interest? Essentially, open interest is the number of contracts which are outstanding, number of contracts which are outstanding. So if the open interest is on the higher side, prices falling, open interest on the higher side, prices going up, what it has to reflect with respect to the market segment. So essentially, open interest is a study which is undertaken in case of derivatives trading. And I discussed about the trend and the trend reversal. So these are the approaches which have to be seen in case of technical analysis. Some jargons which you should know, because as I said, this happens to be the very first session of our technical analysis. I'm sure some of you are anxiously and desperately waiting for RSI. Wait, I'll come to that. All right. So support, resistance, reversal. What is reversal? What is range bound? So I've already discussed about the range bound, but let me take you through I've discussed about reversal and range bound. Let me take you to this concept of support and resistance. So we can move to the next one. Yeah. So what is support and what is resistance and what is it has to. Now resistance, as you can see, is a so once when the market has moved at a considerable high, market has moved towards a considerable high, and you are actually not getting any trigger or any piece of information as to which direction the market is going to move from there on. So the market is somewhat stagnant at that point in time, just trying to sort of perceive whether it is going to move further high from there or whether it is going to come down. Right? So it occurs when an uptrend is expected to pause temporarily. And it is at this point in time that some of the investors might think that since it has touched the highest peak in the history of that particular stock or within that given time frame, why not to sell and come out in the price? So thereby, if you will find that some informed traders or rational traders, okay, they might think that it's the best time to sort of sell and to book profits, come out of the market, and that is the best strategy which should happen, because what is generally seen is once when the prices move very very high, uh, essentially maybe the price earnings ratio is very very high for that particular stock with very positive sentiment. What happens? The price touches higher high. It has reached the peak. Okay, and we have seen history says that after that there is a decline which is likely to happen. Now that how long or how deep that decline is, that is something which is a matter of time. But ideally, it is best time to sort of fix. The market is already at its peak. Coming to the support level. So yeah, I was with the previous one only. Coming to the support level. So one the support level is market has hit rock bottom, and you're very sure that market will not go beyond. I mean, it will not come down beyond that level. So essentially, that is the right time to buy to enter the market. Okay, and so these are the kind of triggers which the market will give as to what is the resistance, what is the support, and then you will be taking your positions in the. Okay, so support is giving you an opportunity to sort of enter. Resistance is essentially, as we have seen, the historical chart says that after it has reached the peak, it's better to sort of come out of that. Okay, move to the next, please. Yeah, so reversal, you can see the market, if you see that red candle, okay, it towards the bottom, okay, you find that the market has actually come down to rock bottom, which is the support, okay, okay, and from there on, the market is going to go up. So this is what is essentially called as reversal. The market has moved down for a considerable period of time, and now it is going to go up. So it's nothing but a reflection of your business cycle or your economic cycle. And this happens. This happens. So we are just waiting the kind of reversal. If you recall the way the market was moving very high and we were very optimistic, and we had all those information, and the market is going to touch 50,000. Okay, so what happened? We are still not aware where the market is going to move from there, from here on essentially. Okay, so we are all waiting for that reversal to happen. Okay, we can move to the next. I've discussed this range bound, so I hope that you all will be pretty clear with this. Yeah, we can move to the next. So strengths and weakness, I'll just take you through the bullet points. I am sure you must have understood what are the strengths of technical analysis. Remember, it is not just for stocks. It is applicable for futures, for commodities, for fixed income securities, for forex. So if you understand the nuances of technical charts, you can apply it in any of these asset classes. So this is one of the strengths of technical analysis. The next one is, we can move to the next. Yes, it is essentially focus on the price, and we know that the price discounts everything. So once when everything is discounted in the form of price, okay, then you have to just depend upon the price movements and accordingly uh, strategize. Okay, so just by focusing only on price actions, technicians focus on the future. So you can do your forecasting based on the price movements. Next. Yeah, so supply, demand, and price actions. So all these things put together gives you a very clear understanding as to which direction the market is going to move. So technicians make use of high, low, and closing prices to analyze the price action of a stock. And a good analysis can be made only when all the above information is present. Okay, in terms of supply, in terms of demand, in terms of price actions. Okay, so essentially you look at the price and the volumes, which I discussed. Okay, we can move to the next. Yeah, support and resistance. So that gives you a very clear cut kind of an indication whether to enter the market or whether to sort of fit the market. Okay, uh, so yes, that is what we have already discussed. Pictorial price history. So it is always said that looking at the charts or looking at the graphs gives you lot of valuable information which otherwise number crunching is sort of not. If you just have a look at the chart, if you look at the graph, the way the asset classes is moving, whichever direction it is, it gives you a plethora of information, which may be more significant as compared to numbers. Yes. So, yeah, so this is one thing because you can manipulate with the numbers, but not with the prices to that extent. Okay. Yeah, assist with entry point and assist with the exit point, which is what we understand by looking at the support and resistance. We discussed that. Okay. So what are the breakouts? We will understand what are the breakouts essentially as we go ahead. Weakness, as I said, for some they might think it is the right time to exit. Some might think it is the right time to enter. So it's how you interpret. So essentially, the analyst bias will be there. Open to interpretation. As I said, I might interpret it in a different manner. You might interpret it in a different manner. So it's just like the common saying which goes, is the cup half empty or half full? And it is in the eye of the beholder. Are you taking? So for me, it is an opportunity. I would want to enter. For others, they think no, enough. It's better to move. It's fundamental. So open to interpretation. Too late. Yes, this is important. Now you can criticize the technical analysis for being too late. So when the time the trend is identified, a substantial move has already taken place, and maybe you have missed the bus. So it's like that. So the moment you realize maybe the trigger is over, and another weakness with, or I would say another limitation of technical analysis is uh, uh, you always think, what is the other level? So if the market is going high, you will wait, okay, let me see what is the other level, what is the other level, what is the other level, and finally what happens? So you miss the bus. So what happened to one of the stock a few months back was your Yes Bank. So Yes Bank, just look at the ride or the stride of the Yes Bank, and eventually what happened? So we all know that story, right? So those who exited at the right time based on the price movements coupled with the volumes must have made a very judicious and a very conscious decision by looking at the charts. But if you keep on thinking there is another level, so it's just like greed and fear. So all your behavioral finance is ultimately getting, it is a part of your strategy. And you have to strike a balance between your greed and fear. So don't think there is another level, another level. What level? So either what level of entry or what level of exit. Okay, we can move to the next. Traders' remorse, yes, an array of pattern and indicators arise while studying technical analysis. Not all signals actually work. Remember, not all signals actually work the way you had perceived it to be. Okay, so a 50-day moving average. So what is, we will understand this once when we are into moving average, and what one of my, I am seeing Krutik is asking something about RSI. And yeah, he's asking about the recent trends. Yeah, we'll come to that, and I'll be discussing all of that. Uh, okay, So a 50-day moving average may work great to identify support and resistance for Infosys, but a 70-day moving average may work better for Reliance. So it's a trader's remorse essentially. So how you actually sort of, so at times certain signals might work for some of these stocks, certain signals might be working for other set of stocks. Yeah, yeah. So we can move to the next. Yeah, we can move to the next. I think that we have covered all of these up. And now, Indu, if you is it shall I continue or yeah, or is it good time to stop? What's it? So yeah, so next in line is your bar chart, okay? And I'll quickly take you to the bar chart before I close, just to sensitize you with the bar chart because after this we'll be understanding what kind of information you get only by looking at the bar chart, and then we will be moving to the candlestick chart, and then to the various chart types which you are asking. Some of you are asking over here. So yeah, I can I move to the previous slide, previous slide, Hindu? Yeah. So this is a bar chart, as you can see, and what you see is a green bar and a red bar. All right, and you are seeing two ticks. You are seeing two ticks over here. One is towards the right, and the other is towards your left. All right, and then you can see a high, something written as high at the very tip of that bar, and you are seeing something as the low at the very bottom of that particular bar, right? So the tip of the bar signifies the highest price related to that particular asset class. Maybe an index, it may be a stock, it may be a commodity, okay? Whereas if you look at the low, that is showing what was the lowest price on that particular day. Now you're seeing two ticks, one on the right side and one on the left side. All right. So the one on the right side, it is showing what was the close, and one on the left side shows what was the open. So if the close is higher than the opening price, it indicates a positive sentiment. It indicates a positive sentiment. Whereas the one wherein you are seeing that the bar is red in color, the bar is red in color, you find that though the high and low is, it's very much at par with the green one, but just emphasize or look at the open and the close. So the closing price is much lower than the opening price. I repeat, the closing price is much lower than the opening price. So this indicates a negative set. Okay, we can move to the next. Yeah. Okay, I think so. I've just touched upon the bar chart today, and we'll continue with our discussion on bar chart in our subsequent session. And then from there on, we will understand what is breakouts and other such jargons. And then subsequently, after having touching each and every point with respect to the bar chart, we then move to the candlestick. And once when you have understood the bar chart, candlestick will not take much of the time. So with that, I stop with my today's presentation. Yes, we have to move. Yeah, we are moving towards close, and yes, we are good to close for today. Thank you so much for being there. Being great, sort of making this presentation for you. Thanks a lot, and we'll be meeting sometime soon next week. Thank you so much. Have a good time ahead, and take good care. Bye bye.
Thank you so much, Sangeeta, for this insightful session. And I'm sure this session was a meaningful session for all of you. And now we would like you to share your feedback so that we can, improvise our future sessions. And our next session will be on technical analysis part 2. In this session, we will explain you candlestick chart, how it works, and the importance of it on technical analysis. If you want to know everything about it in advance related to this topic, you can just drop your comments. And one more thing, let us know your area of interest and what topics you guys want to learn first. Based on your topics and priorities, we will set our future classes. Till then, revise your what you have learned today, and you can watch this session again on 5paisa YouTube channel, and you can read all the stuff related to stock market at 5paisa school platform. In our next session, we are going to discuss this, as we have told earlier, that we are going to discuss this candlestick chart. So till then, thank you so much guys for joining in. And for Hindi viewers, जो अभी हिंदी में इस वेबिनार को समझना चाहते हैं, संगीता जी हमारे साथ बनी हुई है। आप 5paisa के यूट्यूब चैनल में जाइए और वहाँ पर जो हिंदी वेबिनार का लिंक है वहाँ पर क्लिक कीजिए और उसे तुरंत ज्वाइन कर लीजिए। 4:15 से हम वहाँ पर ये सेशन शुरू करने वाले हैं। आप सभी का बहुत बहुत शुक्रिया।